Welcome everyone to the Trust the Plan podcast. I'm Nick.
And I'm Jim.
Jim, this is a beautiful picture of our office from 2004.
It does look really nice. There's some things have changed a little bit, huh? I think some of the trees have grown up a little.
Yeah, these trees are now huge.
Yeah.
And they provide full canopy cover of all the grass.
Yeah.
So you really need that sunshade grass seed mix, you know?
That's what I'm looking at. I'm jealous of how thick the lawn looks now.
It's pretty lush.
Back then, yeah.
Yeah, and then the trees, to give you an idea, are so big. We have a Peak logo on that brick right there. Like you can never see the logo because the foliage covers it all. Okay,
Yeah.
So what a waste of money on that sign, you know. But also the raccoons, they can climb from the trees onto the roof. Which sometimes can be a problem.
Can cause trouble. Yeah.
Yes, those pesky raccoons. So, Jim, today we're talking about the RIA business model, and I think that our clients and friends might find it interesting because they don't think about it much, but it can kind of pull back, open the hood a little bit, kick the tires a little bit, and see some of the trends in the industry over the last couple of decades. So Barron's had this article about the RIA. It's Registered Investment Advisor, which is what we are, the business model. And over the last 20 years, the number of RIA firms in the U.S. has doubled. So that's a pretty good growth rate. What is it? If the rule of 72, if it doubles in 10 years, that's 7% growth, 7.2%.
Yeah.
So it's like 3.6% growth rate. So it's like not a rocket ship, right? But it is, steady growth.
Yeah.
Okay. And I've often told people, I believe that if you have success at a wirehouse, like one of the New York firms, for example, you know the names. I don't think I'm going to say the names. Okay. So you're at the wirehouse, you have success, and you think, wow, I'm tired of doing everything that, the mothership in New York tells me. I don't really believe in this strategy, but I don't have any way around it. I have to charge these high fees, and I have a limited offering, right? You think if I'm independent, I could do all these things my way, okay? And so you leave the big national New York firm, and then you go independent. Maybe you still have a broker dealer, okay? Like this is the path that we were on when we started, right?
Yep.
And that's a pretty good setup, right? You're independent, but not perfectly independent. Okay, there's still more that you could want to be completely autonomous from the mothership. Okay, and then you leave that company and you move your clients to Schwab. Okay, which is where we are as the RIA, and here, right, we have our own logo. We're doing business as Peak Wealth Management. We decide who we hire and fire and who we use for our managers, for our strategists, and we have the strategy that we think that you need, not because we are incentivized to recommend it, right? Like you just do business, in my opinion, the right way.
Yeah, we have no quotas for how many CDs we sold or annuities we sold, how many of this strategist did we use. Like all of it is completely independent, and that's what attracted us both, obviously, to this business model.
Yeah. So like water flows downhill, right? You go from the wirehouse to independent to RIA. And that trend has been happening over the last couple decades, as Barron's noted, by the firms doubling, okay? But now we have some new things happening, okay, where the private equity money, there's a lot of money floating around in our industry, and they're buying up these, well, let's say that we are the advisor-led RIA, right? Advisors who are in the practice own the practice. So these big companies are coming in and buying up the RIA, and they're joining them all together. And I find that interesting because, in order for the private equity companies to make money, oftentimes they want you to raise their fees. Oftentimes they want you to use their investment models. Oftentimes they want you to use these software programs to run your business. Oftentimes they want to determine wages for everyone in the family, in the office. Okay, and to me, it seems like you're going backwards, right? Like back to New York, back to the mothership, where you are following, all of those rules that they have for you.
Yeah. Now somebody cares how much you're charging and what investments you're using, and all of those things that we tried to get away from. It seems like you're signing back up for that. That kind of oversight.
That's right. Now, why would someone want to do that, right? Well, they're selling the firm, right? So they're kind of cashing out, right? And so it's tempting for a lot of people because it's a lot of money, right? It's like you're monetizing your business. And, the analogy maybe is like with rental real estate. Several months ago, we did this podcast, and I said, hey, I'm really tired of some of these properties. I'm just going to sell them and cash out, right? Just get the money, right? Well, at some point, a lot of advisors, they've been doing it for 30 years or whatever, that becomes appealing, right? They're tired. They're just, ready to move on, right? And so you monetize. So I get it. But I think the optimal scenario, right, for the clients and for everyone involved is if you're able to manage the firm, generational or, into perpetuity kind of a thing, like for the next 100 years, right? Yeah. And oftentimes that means you stay on, like the ownership like stays on for an extended time. And maybe you're not, an advisor anymore or even the CEO, right? Or like president, whatever. You're like the chairman, right? But you're still involved because, it's your baby, right? Like you started the firm. And so you can stay on forever and the next generation can come up and kind of run the show, right? And ideally, it would be younger people that were part of your firm for a long time. And so they're just a carbon copy, right?
Right.
To be nice about it. Not to be, it's in a good way, right?
Yeah.
So this way, you don't have to, change the culture to the national firm. You don't have to be restricted with what you can offer. You don't have to follow all of these rules that might not be best for the end client just because the owner wants to cash out.
Yeah. I mean, that sounds spot on. I think in those situations, like you mentioned, for people who are selling and stuff, maybe they just don't have a good succession plan in place. And that's what we're talking about here, is making sure you have something in place that can keep, that business continuing to go the way it is.
Yeah. And so I just feel like it's like full circle. It's coming full circle.
Yeah,
so instead of being the New York firm, right, where you're following all those rules, you get away, you got your own company, and then instead of being a big New York firm, it's a big firm out of Omaha.
Yeah.
Like, okay, well, do I have autonomy? Maybe not.
Right.
So I find it interesting. And so I just want our customers and our clients to know that, right, Jim and I as owners of Peak, right, we always put, like we adhere and follow the fiduciary standard, like for real, okay? Which means all advice that we give is always in your best interest and not ours. And I feel like when you start getting mixed up with, the national firms, you just want to ask yourself that question.
Yeah.
Is this advice in my best interest or in someone else's?
Yeah, there's a lot more voices in your ear now trying to get you to do one thing or the other. So
Yeah. So if you would like to talk about what it means to be a fiduciary or what the heck is an RIA anyway, we're happy to have that conversation with you. You can reach out to us at peakwm.com. If you like this topic, ring the bell, subscribe, share with your friends. Thank you.